it's time for us to head to the real world, all of financial accounting and financial reporting. We'll start with the income statement. So you have the income statement, which we said is the reflection of the financial performance of the entity. And the way we start is with sales. So you have sale of goods. For selling the goods, you'll have certain cost of those goods sold. So that is something we call COGS, gives us gross. So this is the gross margin. Then you also have certain selling, general and administrative expenses called SG&A. This gives you operating income. So this is income from primary operations. Then we have non-operating income, gains and losses. So this is something which is incidental to these primary operations. So this plus this gives us our income from continuing operations before tax. Now we got to pay our income taxes. So that's tax. This gives income from continuing operations after tax. Then you have discontinued operations. So this is all something which are continuing operations. Let's say we have certain portions of our operations which we have sold off during the year, or which are held for sale, which we intend to sell it off in the near future. That becomes discontinued operations. We want to show that, present that separately from what's our continuing operations. This is something which we were doing last year and we are planning to do in the foreseeable future. This is discontinued. You might have certain extraordinary gains or losses. Now, when we said non-operating gains or losses, these are something which would be unusual or infrequent. Extraordinary is something which is unusual and infrequent, unusual in nature and infrequent in occurrence. We'll talk about that as we move on. So this gives us the net income. Now, to the net income, there's something which we add, which is called the other comprehensive income, OCI. This is like a parking lot, which we don't want to show it up here. We want to show it down separately from net income. So net income plus OCI gives us comprehensive income. Now, we'll talk in detail about the comprehensive income concept, but for now understand, this is a number that the stockholders, they're looking at, net income. What has the entity earned during the year? This is something which you want to park it. We don't want to show it in net income this year. We might want to bring it to net income somewhere later, or these are temporary stuff which are going to reverse off with time. So we want to keep it away from net income. Now, from sales to net income, this is the part which we call the income statement. So your income statement ends here. Net income plus OCI, other comprehensive income, which gives you your comprehensive income. This part is called the comprehensive income statement. Now, for the comprehensive income statement, you have two options of presentation. Number one, you present it after the income statement. So this entire thing would become a statement of earnings and comprehensive income. Or present two separate statements. One is the income statement, second is the comprehensive income statement. So net income, which is the last line of the income statement, is actually the first line of the comprehensive income statement. So we'll talk about that in a moment. So let's get back up to our sales revenue. So guys, I'm sure you're good with the concepts now. Remember the concept for revenue recognition? You should have earned it and it should be realized or realizable. So you recognize revenue only when it's earned and it's either realized, you receive the cash, or you're sure you're going to receive the cash in course of time. So that becomes sales, you recognize revenue. And we put net sales here. By net, I mean we're going to use gross sales, all the sales that we've made, minus any sales discounts that we've offered, minus any sales returns or allowances. Then you have COGS, cost of goods sold. Now, if you remember, I told you COGS, that's a product cost. We'll elaborate on this in a moment. So COGS is calculated like this. So you have beginning inventory. That's like opening inventory. So that's the inventory you started the year or started the period with. Then during the period you purchased goods, so plus purchases. Now to this you also add any cost of freight in. So when you purchase goods, you might have paid certain freight. So freight in is added to purchases. You also add any direct manufacturing costs. Now, if you're a wholesaler or a retailer, you don't have many manufacturing costs. But if you're a manufacturer, then you would have manufacturing costs. So if you're just buying and selling goods, doing nothing on that, doing no manufacturing, there's no manufacturing cost for you. Now, this is all your cost of goods available for sale. This is all that you could have sold. So you had some inventory to start with, you bought some goods. That is all you had available to sell. Now, did you sell all of it? Or you sold only a part of it? You also had something like ending inventory. That gives us the cost of goods sold. So if your ending inventory is 0, that means you had some beginning inventory, you bought some goods, you sold all of it, you had 0 ending inventory. That means your cost of goods available for sale is the same as cost of goods sold. Only if you were not able to sell off everything, that's when you have ending inventory, which gets reduced from cost of goods available for sale, gives you cost of goods sold. Now, next you have gross margin, selling, general and administrative. SG&A, this is a period cost. I'll elaborate on that in just a moment. We talked about product cost and period cost when we did concepts. Remember expense matching? We'll do that again. Now, when we're talking about COGS versus SG&A, it's important for us to understand. So let's say we've paid out salaries. Now, we would pay out salaries to our factory workers, factory supervisors. We would need to pay salaries to our salesmen, our marketing personnel. We would need to pay salaries to our officers. So when we pay salaries to factory workers, factory supervisors, that's cost of goods sold. That's direct manufacturing costs. When we pay salaries to our salesmen, that's selling expense. When we are paying salaries to our officers, that's G&A. Think about rent. Let's say we're paying rent for a factory building. That's COGS, direct manufacturing costs. We're paying rent for our warehouse, sales warehouse, selling. We are paying rent for our office administrative block, G&A. So though it's salary expense, it could be COGS, selling or G&A. Though it's a rent expense, COGS, selling or G&A. How about depreciation? Let's say we have certain amount of depreciation on our factory building COGS. Depreciation on delivery vans, selling. Depreciation on office equipment, office computers, G&A. So guys, you need to understand what we are doing here is called functional classification. Is it used for the factory? Is it used for selling? Or is it used for administration? So that's how you divide your expenses. We're not doing a natural classification. We don't have all the rent number together. We don't have all the salaries number together, all the depreciation together. No. We split it up in as per function. Is it factory, selling or administrative? I also told you that COGS is product cost and SG&A is period cost. Let's try to understand this with an example. Let's say I'm in the business of selling pens. I buy pens, I sell pens. I don't manufacture them. I'm a reseller. So let's say I started my year with no pens, 0 beginning inventory. Then I said I'm going to buy 1,000 pens and I paid $1 for each pens. So I bought 1,000 pens for $1,000. During the year, I couldn't sell all 1,000. I sold 700 of those pens for $2 each. So let's put that on. Let's get the numbers here. So I bought